To short or not to short? That's the question. While it seems like it's an obvious choice that you should say yes, because why not? You're already in degen land crypto anyway. Yes, shorting the market means that you can make a ton of money as the price moves down for BTC. So instead of crying as your bags are getting heavier, you're actually making money as the price goes down. In fact, you might even be so bold as to cheer on bearish price action. How dare you? Do you ever get the feeling like shorting is kind of like going against your inner spirit, man, when you're trading crypto? At least for me, it does. It always feels like if I'm going to short crypto, man, I need to be really certain, really sure. And most of all, the big question is, do you really need to short crypto? I'm going to talk about my specific opinions on this topic here in this video on More Coin Bureau. What's up? My name is Aaron Dishner from The Better Traders. We're going to get into this real quick. I'm going to make this as clear as I possibly can. So, the idea of shorting is simple. And actually, it was devised as a way for you to protect your portfolio, not to ape a short, a 400x short into BTC at the Pico tops. That way you can make a ton of money. But the real question is shorting worth it? Now, the first thing I'll say is that it's very similar to going long. It's very tricky to find out where the absolute Pico bottom is. Most of the time, you're not going to be able to find it. So shorting works best if you're using trend-based indicators. I talk about this a lot on the Coin Bureau trading channel. For instance, like the TBO indicator here, lots of different moving averages, but essentially a short setup idea would be when the price goes against the trend, you would set up your stop loss, you have your take profit, and you can let it ride or whatever you want to do. But the idea is simple. You're making money while the price goes down. And not just selling here and just holding onto your stack. You're actually making money as the price goes lower. But the question is, should you short the market? And what are the dangers thereof? I'm going to say it this way. If you've never used leverage, now is not the time to start practicing shorting. I'm going to say that nice and clear. Even though the chances of us heading into a bear market are extremely high for 2026, that's my personal opinion, I still think that if you're going to be using leverage of any sort, even if you're going to short the market, start small. Start with like 2x, 3x leverage. Some platforms boast up to 500x leverage. Like there's literally no need for that. Crypto is already volatile enough. But the one thing I think is worth pointing out in favor of shorting cryptocurrency markets is that, let's be real, when we actually zoom out to look at price action for Bitcoin, while we will have moments where the price does these amazing moves up, how many times have we just been gutted on any sort of news where these massive whipsaw price action, like it's awful, right? And it feels like it's just money sitting on the table. Why wouldn't you want to short? Well, I'm actually going to give you a really easy understanding of why you might not want to consider shorting, especially if you've never done it before. And we're going to go back over here to the 2022 bear market. Bitcoin at its peak was just around $69,000, okay? Now, if we go to the Pico, let me get the very Pico top, There we go. Now, let's say that you magically hit $69,000. You were taking those brainwaves from Elon Musk while everyone was talking about 69,420 back over here in 2020. Everyone laughing their faces off. Bitcoin at 69K. People like, no way, this is so meta. Okay, well, now we're going to zoom ahead. The reality is that as the price fell down a lot, there were lots of these jutting moves upward. The price was going against the trend. And even so, at the very bottom, the reality is that the return on a short with only 1x leverage, as in not using leverage at all, but you're just shorting the market, you are always going to be capped out at basically 99%. Yes, you're using a leverage multiple. So that 77% with 2x leverage will be like 144%, something like that. Or if we're using 10x leverage, it would be 776.7%. It's true. But the reality is that while you can make money on the way down, even though this bull market may not have felt that bullish to you, if we just pick right here, 20K, going all the way up to 100 and we'll just say 100K, period, okay? That in itself is a near 400% move. Yes, you can make money as the price of Bitcoin, Ethereum, alts, they go down lower. Some charts are clearly overbought. Some charts are going to be going down way lower over the course of next year. So can you make money shorting the market? Yes, but you're capped. You can only make up to 99.99%. Whereas to the upside, I mean, Bitcoin is just a very, very meager example. Ethereum would be arguably much worse. But let's look at Solana just to help refresh your memory, okay? While Solana did have a devastating bear market, losing, I believe, 97% of its value during the bear market, the reality is that even if you missed the Pico low and you just bought in here at $24, it moved all the way up to like 240. It moved up 900%. It basically did a 10x to the upside, going back up to this resistance level. It doesn't happen right away, but you can make exponentially more money when prices are going up. The problem, obviously, is that we know crypto rarely actually goes in the direction we want it to go. That would be up. So there's another thing to think about as well when it comes to opening up a short position. Let's say that you entered into a very profitable short. You caught the first reversal rally right over here for Solana. You nailed it. Good job. You're still in your short. You're going to hold this short for the entire time. And let's say that you miss the bottom, okay? You have missed the complete bottom. Oh no, too bad for you. And you decide, okay, I'm going to close it here. Awesome. You close it at a 90% profit. Amazing. Good job. You made a ton of cash. The problem that most people do not factor in when it comes to shorting or going long are fees, funding fees. Keeping a position open for a year is going to cost you so much in fees. Sometimes the short will pay itself off, but the idea is that to keep that position funded and open, especially if you're in profit, what happens is that the exchanges but they're basically taking counterprotective measures. They want to make sure that they're protecting their end while you're making money. So in order for you to keep a profitable position open, they're going to charge you for keeping it open. So if you're going to keep it open for 290 days, these fees do not accrue at the end of 24 hours. Some exchanges are as quick as an hour. Some are 4 hours. It just depends on the exchange. These are the funding rates that you might hear about sometime. We're not going to go into all the details of that. But what I think you should also factor in as well is not just the funding fees, but also the risk of getting liquidated. Now, when I'm using this tool right here to show entering a short position, you want to get stopped out. You don't want to get liquidated. But I want to share something really interesting with you in this video when it comes to using leverage, because there's actually a benefit to you if you are going short versus long. Yeah, you heard me right. You will actually be safer shorting the market than going long. This is a little bit of a weird thing to consider, okay? Just hear me out. This calculator, this Google Sheet, by the way, is in the description below. Go ahead and in the File menu, make a copy. Don't ask me for permission to use the sheet. Make a copy, save it to your own drive, okay? Awesome. And there are also links over here to sign up for stuff. So if you want to be trading on futures-based exchanges or leverage exchanges, WeX, BYDFi, or 2bit, which is a non-KYC requiring exchange, use the links. You're awesome. Now, here's the concept. If I'm using 10x leverage and I'm entering right at the exact price of Bitcoin right now, and I'm using a size or margin of $100, that means that my position is now worth $1,000. So I'm 10xing my size. My margin is $100. Now, here's the thing. If we're going long and I'm using a leverage multiple of, we'll just say 2, okay? Just like this. Then our potential profit on 2x leverage for a 10% move is $20. Hooray, we made money. Now, can you make a lot more if it's like 10x? Oh yeah, you can make basically 100%. If I was doing 100x leverage, oh man, I'm making buckets of cash. The problem though, is that the higher the leverage, the higher risk it is. The change in PX, which is price, until liquidation, dramatically reduces. The more leverage you use, the higher risk it is. Why do people love using 100x leverage? Maybe it's because the same reason that people like touching live wires in the middle of a hurricane while they're trying to release a net of balls to survey what happens inside of the hurricane. I don't know why people do the things they do. Don't ask me that. But the reality is that the percentage change required for liquidation dramatically increases and goes closer to your entry. Whereas if you used 100x leverage on BTC, the price only has to move against you by 0.5% and you get liquidated. That would mean the price has to move against you by $440. Sounds like a lot. It's not. It's Bitcoin. Okay? Now, feel free to mess with this. You can play with it. This is pulling in prices from Google Finance, by the way. So you can mess with this, but I would just suggest if you're going to do this, just hear me out. Like, you're going to have to adjust some numbers, okay? But anything that's yellow here, feel free to mess with this. This stuff, don't play with it because this is all set up specifically, okay? Now, yes, you will make far less if you're using less leverage. But the idea is that your liquidation level is so far below the current price that if you decide for whatever reason not to use a stop loss and just leave it open and let it ride like you're back in Vegas, Las Vegas, Nevada, yeah, you're going to want to be really careful about this because letting it ride, risking this margin may not feel like a lot to you, but let's just not get liquidated. I think that's the better thing to do. Don't you think that's the better thing? If your grandma was watching you trade, do you think she'd want you to get liquidated? No, grandma doesn't want you to get liquidated because she never did. She used a stop loss. Be like grandma. Doesn't that sound fun? But I know you guys won't. So if you're using 2x leverage, the percentage change required for you to be liquidated is a 33% drop, which means the price of Bitcoin would have to go lower, which actually, I don't know why I never thought of this before, but let's find out what that price would be. Oops, that's right, I have to do this. So that would be the price of BTC would have to go down to 60K. Go ahead and just make these additions to the sheet. Oh, that's a really good idea. So this is a lot clearer showing you it's extremely risky to use anything really above 10x leverage. And some people are probably gasping at me saying 10x leverage, but you get the idea. You are safer the lower the leverage that you use for liquidation. Here's the thing that's really going to blow your mind. If you were to go short, actually, your leverage multiple means that if you use 2x leverage, the price would have to go way against you in order for you to get liquidated. Again, using the same idea, we're going to do B2. Oh my gosh, I can't type and talk at the same time. Okay, so in order for you to get liquidated in a short position, Bitcoin would have to skyrocket up to $180,000 from the current price at 2x leverage. At 3x leverage, now you're at 50%. Finally, at 4x leverage, now we're starting to be on par with just 2x leverage. What gives? Well, let's be real. We know that we are capped at a total possible profit of 99% because charts can only fall 99.99999%. I'm looking at you, Terra Luna. We all know that that is the lowest things will go. However, we know that charts can absolutely go crazy. 10x, 20x, 50x, literally at the drop of a hat. The exchanges will have to pay so much more money to you to open up your position, especially a leveraged long. So the liquidation prices, or the changes, are a lot closer to the current price. Whereas if you were to use a short position, it's actually less risk. I know it's a little bit weird, but this is actually another reason why you might want to consider using leverage to short the market. But you have to factor in the costs. The last thing we need to talk about is what we're using over here on TradingView. This is the short setup tool, okay? So if we go here on our projection, we have a long position and a short position. The thing you'll notice about this right away is that it has a red area, your stop loss, not a liquidation level, and your target, your profit, okay? So let's say for the sake of an exercise, I want to use 4x leverage for a short position, meaning that Solana would have to go against me by 30%, and then I would be liquidated. I don't recommend this to anybody, but we'll just say, okay, that's what it is. So in order for you to be profitable not only does the price have to go in your favor, but you actually want to see it go a lot lower. This risk to reward ratio of 0.82 is really bad. You want that to be at least to 2. You want it to be 2 to 1, meaning that you want to be risking 1 lot to earn 2 lots, $100 to earn $200, $1,000 to earn $2,000. You get the idea. So the problem quickly reveals itself. In order for you to have really good results with really, really low leverage, you're basically betting on a very, very big drop. To even get to 3 to 1, which is what most traders really, really like to use, the price of Solana would have to drop back down to $4, dropping 97% from the current price. It's probably not going to happen, okay? So the problem that presents itself in using low leverage is that, yes, your liquidation price is very high above the current price. We'd have to have a crazy rally that happens, and you are protected. So if you are using this kind of a leverage up here, and you were prepared for a 30% move against you, you actually would be okay in your position. But right now, if you took that short right there, you would only be in profit at 45%, but your risk reward is still at 1.45. In order to get that sweet spot of a 3, the price of Solana would still have to fall another 93% down to $16. Might not happen. Okay? This is the rub. This is where leverage starts to go, And don't forget that during this entire time that this short has been open, and currently, if we just measure this out real quick, this has been open now for 96 days, almost 100 days. You're paying funding fees from anywhere to every 1 hour, every 2 hours, or maybe every 4 hours. So it's costing you money to keep this short open. Yes, it's low risk, but you're also paying to play. Am I saying that, no, you should never short the market? No, you can do what you want to do. You got your big boy pants on. You can do whatever you want. But I am being extremely clear that we know that charts are limited in their drawdown. They can really only fall 99.99999%. But on the flip side, we could see them go so much higher. A 2,500% increase for Solana is ridiculous. And with 2x leverage, that's 5,000. With 4x leverage, that's 10,000% return. Okay? What I'm saying at least is leverage does have its benefits, but you have to factor in the cost of keeping the position open due to funding fees. You have to factor in your liquidation levels and your price points. You want to think about your risk to reward factors, all that stuff. It's not just like, I'm going to throw some money at this and I think it's going to make me money as the price goes down. Maybe. But again, the sole purpose of shorting the market is to hedge your portfolio against a falling market. I do believe that we're going to be going into a bear market in 2026. So you could explore the idea of shorting. And again, I'd love it if you use the links that are in the sheet or also down below. But the main thing to focus on is that you have to practice this first. Spend some time looking at charts and do not expect fireworks. Don't expect every trade to end in a profit. I'm not trying to glitz this up to be like, this is the secret formula. You should be shorting everything. That's not the case because we've seen too many whales get liquidated, publicly humiliated over and over and over. Can you make money shorting? Yes, but you have to weigh the costs, literally, with keeping that short open. I want you to watch this video next that's going to give you some ideas on how to find new narratives. Now, this works actually to the downside, things that are all falling together. You can use the same concept with narratives and everything is dumping. So watch this video. Until the next time, you know what to do. Stay awesome and stay in the green. Peace.